Okay, so we'll start with portfolio management today. Okay. So portfolio risk and return part 1. So because we are doing this after quantitative methods, it should be much easier because covariance, variance, standard deviation, all these will keep coming here. Okay. Now historical risk and return. So here, this is just some facts. Like small cap has given 12% return with the standard deviation of 31 percentage. Large cap. So these are just facts for US. Okay. So small cap turns out to be the best asset class with 12.1 percentage, but highly risky as well, 31.7 percentage. Large cap, little less return, but then much lower risk as well. Then corporate bonds again further little less, and then lower risk as well. Government bond has given less return, but then deviation is quite higher. Okay, treasury bills and then inflation. So this is all very basic stuff only and more memory based only. Now here, risk aversion, risk seeker, and then risk neutral. Risk averse investor means what? Risk averse means someone who is not ready to take risk. Yeah. Okay. Prefers less risk to more risk. Okay. It's not that he doesn't want to take risk, but then he just needs more returns to take risk, more motivation he needs to take risk. More motivation means he needs more returns. Like for example, I might say like, I don't want to do any night shift. And then I get to know that there is a company which is offering me 2 lakhs per month salary. Now will I still say I'm not okay for night shift and so I'm leaving 2 lakhs job? No. So that means I'm ready for night shift. It's just that I'm not getting the payment that I want. If I get, I'm ready. That means. So risk covers means it's not that completely I'm saying no. It's just that my expectations are little higher. I want higher package for night shift. That way. Similarly here, risk averse investors means they want more returns for the given level of risk. Okay, for the given level of risk, they want more returns. That is called risk averse. Okay. See, given two investments that have equal expected return, a risk averse investor will choose the one with less risk. Say, for example, for one standard deviation is 15 percentage and it is giving you return of 12 percentage. And second one is giving you return of, let's say, 14 percentage and for the same 15 percentage. So that means risk averse will go for this one. Where is not sorry, not for this one, this one. Equal risk. No? Yeah. Okay. Then risk seeker. Risk seeker means somebody who invest in, say for example, penny stock. So now all penny stock investors are what? They are risk seeker because they are going to get very less. Many times when they are investing in penny stocks, they will get very less returns. Okay. But then they are okay and they are happy with it as well. So that is risk seeker. So that means it is like an employee who says, I'm ready for night shift, day shift, 10 hours, 15 hours, any hours is okay for me. Okay, just give me the salary. That is risk seeker. He is ready to take risk. Okay. Risk seeker as in you are taking more risk than the market actually. For the same output, for the same returns, you are ready to take more returns. Risk neutral means you don't care only about the risk. All you are focusing on is that I want return. Like for example, there is an investor who says it doesn't matter whether it is a small cap or mid cap or large cap, as long as I'm getting good returns. So you are risk neutral. You don't care what is the risk in large cap. Why you don't care what is the risk in large cap, small cap, mid cap? Because let's say you are a long-term investor, so you are thinking that how does it matter whether it is small cap, mid cap, or large cap? All I'm interested in is to make sure that this company is good. Okay, good, fundamentally strong that way. So risk neutral means he will ignore risk. He will just focus on the returns. So for him, it doesn't matter whether it is a large cap, small cap, mid cap. Risk seeker means he will deliberately go into risky thing. Okay, example, as I said, small cap, penny stock, or else could be like uh, whose IPO has not come. So such kind of stocks. So those are all risk seeker.
So in this case, the risk seeker is not concerned about the returns at all.
Risk seeker, he will not see the right match. Say for example, if somebody is investing in a penny stock, ideally he should get very high return. But even
Yeah.
if he is getting 10-15% return, he is very happy. But did he get what he deserved? Because he took much more risk, no, by investing in a penny stock.
Yeah.
But then he didn't get that. What he got was a normal return, 10 to 15 percentage. But still he is continuing to invest in. That means he's a risk seeker.
Okay.
So now see this one. A coin is flipped. If it comes up heads, you receive $100. If it comes up tails, you receive nothing. So head is $100.
This is
Tail
game
is
theory, right?
um, not exactly game theory. Not game theory.
Okay.
Yeah, not game theory. See, tail. So when I say game, when you say game theory, what do you understand in game theory? In
So I was
economics, we did that game
yeah,
theory.
yeah, yeah. I
Yeah.
had that in economics, so that's why.
So game theory, that prisoner's dilemma. That is prisoner's dilemma.
Yeah.
Okay, not that one. So this is in investor psychology. This is more to do with investor psychology. In game
Okay.
theory, two competitors are suspecting each other. Okay, whereas here, here you have to there you have to make one decision, and how the psychology plays for you to make decision. Say for
Okay.
example, head is, if you get head, imagine a coin is being flipped. If you get head, if it comes as head, then $100 will be given to you. If it comes as tail, then you receive nothing. The expected payoff is so expected payoff will be, now because 50% is the probability for head and 50% is the probability for tail. So expected payoff is equal to 50 percentage of 100, or that's why plus 50 percentage of 0. So that comes to 50.
50.
Okay. A risk averse investor would choose a payment of 50 over the gamble. Hmm. A risk averse would choose a payment of 50, okay, over the gamble. A risk seeking investor would prefer the gamble to a certain payment of 50. A risk neutral investor would be indifferent between the gamble and a certain payment of 50. Are you able to understand this now?
So risk averse will choose not to participate at all
Risk
in the gamble.
averse would choose a payment, a certain outcome over the gamble. That means uh, uh, he will uh, he will participate in it, because if he's, there should be one more line that if you don't participate you will get 50, or
Yes.
no, then there is no point. No, nobody will. There should be one more, that if you don't participate you will get 50. Then the risk hours will go for 50. The risk hours will go for 50, and the risk seeker will go for taking risk, and the risk neutral will be indifferent. For him anything is okay. Okay,
Okay.
that is investor psychology. Now utility functions. and indifference curve. Utility function means what? Now,
If screen is not visible,
not visible. Shravani, are you able to see the
no.
screen?
Yes.
Okay. So I think it is not visible for you only, Ojas. You might want to just rejoin again.
Sir, actually, I am out. I don't have my laptop right now, so I was joined from my phone.
Okay. So I don't know how do I make this visible for you now, because Shravani is able to see it.
No issue, sir. I'll
Hmm.
see the
You
recording
just
again.
you just try once again. If it doesn't work, then
Okay, sir.
you drop out. Anyways, I'm recording it. Okay.
Okay, sir.
Okay. Yeah.
So also I wanted to ask, can we take lectures in the morning from tomorrow?
Yes, that works for me also.
Morning.
Or
Okay.
afternoon.
Okay. Then
Yeah,
I
morning
will.
or afternoon.
Okay, I will plan accordingly then. Okay. Morning is better for you
Yes,
both.
sir.
Okay. Okay, then I will plan accordingly then. Okay. Okay. So morning as in till afternoon, any time is okay, right? Till 8. What time?
Yeah,
From okay.
anytime you say, or
Okay, fine.
anytime. Like,
Okay, fine. So
yeah.
early morning is also fine for you. Early morning as in
Yes.
like something like
For me, it's fine.
7 to 9 is okay.
Yes.
Yes,
Okay.
sir.
Or even 11 to 1 is also fine. 11 to 1.
Yes, sir.
Yes, sir. 11 to 1 is also fine.
Okay, fine. I'll check and then I'll update you. Okay.
So actually, tomorrow, not 11 to 1. Like, I'm not there from 11 to 1. I have a passport appointment.
Okay. Okay. Not for tomorrow, you mean, right? After that.
Yeah, yeah.
Huh. Okay. Okay. Yeah. Okay. Okay. Okay, fine. Now, utility function means what? Utility function represents the preferences regarding the trade-off between risk and return. Okay, and indifference curve is a tool from economics that in this application plots combinations of risk. Okay, indifference curve. See, say for example, one simple example. This is mango, and this is apple. Now you are going to a shop and you are giving 100 rupees and you are asking for mango. Now the shopkeeper says you can go with probably 1 2 3 4 5 1 2 3 4 5. You can go with 3 mango or 1 apple, or you go with 2 mango 2 apple, or you go with 1 mango 3 apple. So you are saying anything is okay for me. That means this is your indifference curve. You are okay with anything on this line. 3 1 2 1 or 1 1 3. This is you are indifferent between the decisions.
Right.
Okay. Now same thing, you are indifferent between the on the utility. Investors utility function represents their preferences regarding the trade-off. So your preference is you are indifferent here. Okay. You are getting equal utility here, equal happiness you are getting. Similarly, now indifference curve for us is return and risk. So this is risk, standard deviation indicates risk, and
Yeah.
this indicates return, expected return. So now expected return, so at this risk somebody is getting this return, at this risk somebody is getting this return, at this risk somebody is getting this return. So that means this is their indifference curve. So that particular investor's indifference curve. So it doesn't matter whether you he's getting equal happiness. Why? Because if he's here, he's taking very high risk and he's getting very high return, or he is okay to be here this risk, this return, or least risk, least return. So that is called as what? Indifference curve, where the investor is indifferent. He says like, it's okay for me, anything is fine. Less risk is taking, less return. Okay. So this graph indicates for different investors. So it can differ from person to person. So for this risk, somebody wants this return. Similarly, for this risk, somebody might expect this much return. And somebody might expect this much return. Somebody might expect this much return. So that means for that another investor, this is the indifference curve. And this is the indifference curve. So indifference curve can differ from person to person, depending upon their nature. Is it okay?
Yes.
Yeah. Yeah. So this is what they have mentioned here. Okay.
So basically, on the indifference curve, it doesn't matter what point they're getting the return. Anything is fine on that curve.
Yeah. You are
Yeah.
fine with any point on this curve. Okay.
Okay.
Just 1 minute. Okay. So this is the indifference curve. The indifference curve of a more risk-averse investor will be steeper than those of a less risk-averse investor, reflecting a high risk aversion. They like asking this kind of questions. Okay. So indifference curve of a risk-averse investor will be steeper. What does that mean? See. Why this is bending, like this? You see, it is little bent. Normally, what happens is that is not required for you, but still, see, normally what happens is for this risk, ideally, normal human behavior is for this risk, this is the return. For this risk, this is the return. But then over a period of time, or when you get used to it, for the same risk, you expect more returns. That's why it is bending beyond a certain limit.
Okay.
Okay, like for example, now when you are working, say for example, as a fresher, you are working and you are getting maybe like 40,000 rupees. Then what will happen? You are happy, let's say. Now, will you be happy 5 years down the line with 40,000 rupees?
No.
No, right? So that time, you want you want probably like double, triple salary. Then only you will be happy that time. So similarly, so what happens this way? The expectations goes up, and that is the reason. Okay. Now risk aversion investors, see why it is steeper. Steeper as in say. This is one indifference curve of person one. Now your person 2 who says, for this risk, I'm ready to, take high risk. So, steeper as in, so there is another person, let's say, for this risk, he is getting this much return. This is steeper, no? So, wait, steeper. See this here. So, risk averse investor, it is steeper. Risk averse. That means for this risk, this is investor 1. Investor 1's indifference curve. And this is investor 2's indifference curve. So for this risk, investor 1 expects this much return. That means you see, for the same risk, he wants high return. And for this risk, investor 2 says, I'm okay with this much return. But he says, no, I need this much return. So he is a risk averse investor. That means it doesn't mean he's never taking risk. He says, I'm ready to take this much risk, but give me this much return.
Right.
So risk averse investor. Okay. Risk averse investor. So you understood this, why it is steeper?
Yes. So for the same amount of risk averse person is expecting more returns.
Yeah.
Okay.
Just one. Yeah. Okay. Just one.
Yes.
Then, okay. You can see the screen there. Okay, can
No,
you
sir.
see the screen? You're not able. Are you able to hear me? Hello?
Yes, sir. I can hear you.
Okay. Yeah, expected return of your portfolio. Expected return of your portfolio is equal to weight of return A plus weight of return B. Are you able to understand this one? It's a very common statement only.
Yes,
Say,
yeah.
for example, hello?
Hello.
Hello?
Yes, sir.
There is loose connection. Wait, I'll just rejoin again.
Okay.
Of A into return of A. So, for example, return of A, expected return of A is equal to 12 percentage, and its probability is equal to 40 percentage. And return of B is equal to 15 percentage, and its probability is 60 percentage. So, in this case, or not probability, let's say you have invested 40 percentage of the amount in return A, that is weight of A, and 60 percentage of the amount in B. Hello, can you hear?
Yes, sir.
Hello.
Hello.
Hello. Hello.
Hello.
You can hear now, right? Okay.
Yes.
Okay. Um, 1 second. Return A is, let's say you have invested 40 percentage of the money in in the 60 percentage of the money in asset B. So asset A has 40 percentage weight and asset B has 60 percentage weight. Now expected return is equal to 12 percentage return into 40 percentage weight, or 15 percentage return into 60 percentage weight. So 40 percentage, just calculate this.
Yes. First is 0.048.
4.8%. That means
Yes. 9.
so 13.8%, right?
Yes.
So have you understood this formula? This is not a formula, it is just common sense that
Yeah.
this is how you will find the expected return. Now, standard deviation of your portfolio. I think from here only the topic all begins. See, standard deviation of your portfolio. I don't remember. Did I tell you this formula? Standard deviation of your portfolio. Standard deviation of your variable. Let's say standard deviation of x is equal to root of summation of x minus x bar the whole square divided by n minus 1. This is the formula, right? This is for one asset.
Yes.
But suppose if you have your portfolio of two assets, so standard deviation of your portfolio of two assets, A and B you have, then it will be root of weight 1 standard deviation 1 square plus weight 2 standard deviation 2 square. Okay, plus. So normally the formula should end over here. Okay, this is
Right.
first one because this is the variance. I'm taking root to find the standard deviation. Okay.
Okay.
So the formula should end over here. I'm taking both the variance. But then,
Right.
however, now what happens is when two assets are coming together. Now, for example, imagine two friends are sitting and studying. So normally friend one, he reads for 2 hours. Another person, he reads for 3 hours. But when they both are coming together and then sitting and studying, then what will happen? Quite possible that A might feel that, look, because B is studying for 3 hours, I should also study for 3 hours. And then B will feel that, look, I should be ahead of A always. So I should study for 4 hours. So they both are getting influenced with each other. And the behavior is changing. Similarly, here also 2 times it is happening. Because of A, B is changing. Because of B, A is changing. So 2 times of weight 1 into standard deviation 1 into weight 2 into standard deviation 2 into R, that is their correlation. Based on their correlation. Okay, based on how much they are getting influenced from each other, that is the correlation.
Yes.
So based on the correlation, this is the standard deviation of the portfolio. Okay, understood this formula?
Yes.
Okay, very important one. Okay, now suppose with the same logic, if I say standard deviation, I think we did this in level 3. No, sorry, in quantitative methods, there
Quants,
was one
portfolio mathematics. Yeah.
for 3 assets. You remember? Did we do?
Yes.
Do you remember the formula?
Yes.
Tell me.
Weight 1 into standard deviation of 1 the whole square plus weight 2 standard deviation 2 the whole square. Weight 3 into standard deviation 3 the whole square. Plus no, actually, I don't remember.
Okay, plus, so this is this logic only, right?
Yeah.
Okay. Plus now, because of the correlation, how they are moving. So 2 into weight 1 into standard deviation 1 into weight 2 into standard deviation 2 and their correlation. Or let me tell you from, I think that was covariance perspective.
Yeah.
So covariance perspective, if I convert this correlation into covariance, then weight 1. First, let me convert this one. Let me convert this one, covariance perspective. Two into weight 1 into standard deviation 1 into weight 2 standard deviation 2 into R is covariance of 1 comma 2 divided by standard deviation of 1 into standard
1.
deviation of 2. So standard
Right.
deviation of 1 gets cancelled, standard deviation of 2 gets cancelled. So So it will be weight 1 standard deviation of 1 square plus weight 2 standard deviation of 2 square plus 2 into weight 1 into weight 2 into covariance of 1 comma 2.
1, 2.
Okay, this is for 2
Yes.
assets. Now with the same logic, if I go for 3 assets, standard deviation of your portfolio for 3 assets. So weight 1 standard deviation of 1 square plus weight 2 standard deviation 2 square plus weight 3 standard deviation weight 3 standard deviation 3 square. Okay, that means this method only. Okay,
Yes.
plus now this covariance between 1 and 2, right? So this will be 2 into weight 1 into weight 2 into,
Covariance 1, 2.
yeah, covariance 1 comma 2. Okay, then plus, okay, plus 2 into weight 2 into weight 3 into covariance of 2 comma 3 plus 2 into weight 1 and 3 now. Weight 1 into weight 3 into 1 comma 3. Okay,
Yes.
the next one, standard deviation of your portfolio. Okay, this is if the if the correlation is 1, suppose if the correlation is 1, now let me go back to correlation perspective only. So correlation perspective, this is the formula, right? If suppose correlation between these two assets are 1, then it will become 1 only.
Yes.
So in that case, this will disappear because it is only 1, right? So
Yes.
now you see, can you, do you get recollected, reminded of anything when you see this formula? Weight 1 standard deviation 1 whole square, weight 2 standard deviation 2 whole square plus 2 into weight 1 standard deviation 1 into weight 2 standard deviation 2. A square plus B square plus 2AB. Do you remember?
Yes. Yeah.
So that takes the shape of what? A plus B the whole square, right? So I can
Yeah.
write this as A uh, A square, A plus B the whole square. So A, yeah, plus B the whole square. A plus B the whole square. No, A square, A plus B the whole square is A square plus B square plus 2.
Yes.
So A plus B the whole square. So this gets cancelled. We are left out with weight 1 standard deviation 1 plus weight 2 standard deviation 2. Okay. I think I have done something wrong. Okay, this is another condition only. I'm just another condition. What is the formula for a square plus 2ab plus b square? It is a plus b the whole square, right? So this is a plus b
Yeah.
the whole square. Acha, this is all correct only. Then, so this is if the correlation is 1. So it must be given somewhere. It must be given ahead. Okay. So if the correlation is 1, this is the result. Is this okay?
Yes, sir.
If the correlation is 1, it is, and what is this result called as? It is called as what? Expected return? Not expected return, expected standard deviation. Weight 1 standard deviation 1 plus weight 2 standard deviation 2. Okay.
Okay.
Now if one of the asset is risk free, then what will happen? If one of the asset is risk free, normally what is the formula? Normally the formula is root of weight 1 standard deviation 1 square plus weight 2 standard deviation 2 square plus 2 into weight 1 standard deviation 1 into weight 2 standard deviation 2 into R. Now if one of the asset is risk free, that means imagine the second asset is risk free, then it will be 0. Its standard deviation will be 0, so all will be 0. So this is
Yes, yeah.
equal to root of weight 1 standard deviation 1 square.
Okay.
So it will be weight 1 standard deviation 1, weight of the portfolio. This is just again common sense, because second asset does not have any risk. So the
Right.
entire portfolio's risk is equal to the weight of that portfolio only. This is what is done here. Weight is standard deviation A.
Okay.
You have written down all this?
No, sir, I'll write it later when I watch the video.
Okay, fine. Okay. So this is okay. Then this is one theory, two fund separation theorem. Two fund separation theorem means this states that all investors' optimal portfolio will be made up of some combination of optimal portfolio of risky assets and risk-free assets. Okay. The line representing this possible combination of risk-free assets and optimal risky asset portfolio is referred to as capital allocation line. That means capital allocation line is okay. Capital allocation line. Actually, capital allocation line is what, see, if this is your risk, this is your indifference curve. Okay. The line drawn tangent to the indifference curve, it is called as, these definitions are given ahead, okay, is called as
Okay.
capital allocation line. That means this is the line, where you will get maximum utility. Okay. This is the line where you will get
Yes.
maximum utility. Okay, so this is where your expectations and the market, what market can give, is matching. Okay, this is where the expectations of the investor is matching with the market. Okay, now
Optimal point, right?
yeah. Okay. So normally, what happens is, like, see, under this two fund separation theorem, investors' optimal portfolio will be made up of some combination of optimal portfolio of risky and some risk-free. So this entire line is the capital allocation line. Now you may invest in this. This is how you should be investing in. Okay, so that means, let's say you are investing here. This, some part you have invested over here, and some part you have invested over here, or some part over here, risk-free, and some part over here, risky, risk-free and risky. Okay.
Yeah.
So it is assuming that a rational investor will be investing in both risk-free as well as risky assets, and that comes under the concept two fund separation theorem. The line representing this possible combinations of risk-free assets and optimal risky asset portfolio, it is referred to as capital allocation line. Okay, we will be seeing more about this line. Okay, capital allocation line. Yeah, see, here is the example. This is capital allocation line. So you have invested in this risky asset and this risky asset as well. Less risky, more risky. Okay, less risky, more risky.
Yeah.
Okay. So this is
Okay.
capital allocation line. Okay. Then, so now you see capital allocation line will differ from investor to investor. So say for example, like this is one capital allocation line for this investor. For another investor, quite possible that the capital allocation line might go like this. Okay. So this is another investor's, I mean, this is the indifference curve. So this is another investor's capital allocation line. So everybody will have individually different capital allocation line depending upon their risk taking ability. Is it okay?
What is the capital allocation line showing? Indifference curve is showing the utility.
Huh.
But what is the
See, this is the indifference curve. Now this is
right?
what is showing your utility, okay, of the investor. Now that has to match with the market as well, no? So what is giving happiness to the
Okay.
investor, it has to match with the market. So what should he do? He should make sure that whatever market is giving, that should match with him, so that he gets maximum satisfaction there. So the line or the kind of investment that he does, which matches with his minimum required utility. Let's say in this case here. Okay, so in this case, this is matching. Okay, or if he invests
Okay.
here also, he is getting utility this much, but the market can give this much only return for him. So what should he do? He should go for this one only. But he is expecting this much, the
Yes.
market is not able to give based on his risk taking appetite. For this risk, this is what the market is giving for him, which will give him maximum, which will give him the returns. Okay, so what it means is the line drawn tangent to the indifference curve. This is just telling uh, what sort of investments client should be doing, so that, or which gives him maximum happiness. What sort of investment is giving him happiness, giving him utility. Okay, so he's expecting this much, but the market is
Okay.
not able to give that much, but the market is able to give here this much. Okay.
Okay. So it could be possible that for certain expectations, there is no capital allocation line because the expectations are just too high than what the market can give.
Yeah. Like imagine if somebody is expecting, like 5 lakhs per month, then only I will be happy. Market may not be able to give that much, no? Okay.
Okay.
So capital allocation line is the line that is drawn tangent to the indifference curve. Why tangent to the indifference curve? So that the utility matches with what the company or what the market can give to him.
Okay.
Okay. How it is articulated is the line drawn tangent to the indifference curve.
Okay. Understood.
And it will differ from person to person. So for another person, this is his indifference curve. So he is happy with this indifference curve itself. So for him, this is the capital allocation line. This is what is giving him happiness, and this is what the market is giving. So both are matching in this line.
Okay.
Okay, then, and here also, Just see this one if you are able to understand. 83.5. Okay, so this figure I need to explain first of all. Now this is investor A. Investor A's indifference curve, and this is investor B's indifference curve. Now this is capital allocation line. Now capital allocation line is same for both. Okay. Now the flatter indifference curve
Yes.
for investor B, flatter, and this is steeper. Okay. The flatter indifference curve for investor B results from an optimal portfolio that lies to the right of the one that results from a steeper indifference curve. So first one is steeper. Okay. First one is steeper. Just 1 minute.
Yes, sir.
1 minute. Okay. The flatter indifference curve for investor B results in an optimal portfolio that lies to the right.
So screen sharing is off.
Oh. The flatter the flatter indifference curve for investor B so you see for this return for this so you take this example for this risk, this investor requires higher return.
Yes.
This investor requires less. So he is what? Risk averse. And
Yeah.
risk averse means what? Steeper. It is steep.
Yes.
And the second one is flatter. This is flatter. Okay. Now you read this. The flatter indifference curve for investor B results in an optimal portfolio that lies to the right of the one that results from a steeper indifference curve, such as that for investor A, the investor who is less risk averse should optimally choose a portfolio with more invested in the risky asset portfolio and less invested in the risk-free asset. An investor who is less risk averse should optimally choose a portfolio. An investor who is less risk averse should optimally choose a portfolio
The B one, yeah, makes sense.
invested in the risky portfolio asset that less invested in. An investor who is less risk averse should optimally choose a portfolio with more invested in the risky portfolio.
So the flatter one.
Latter one.
Yeah.
Okay. Should choose a portfolio with more invested in the risky asset portfolio and less invested in the risk-free assets. Lower the investor's risk aversion, the flatter is the indifference curve. Lower an investor's risk aversion, the flatter is indifference curve. The flatter indifference curve for investor B results in an optimal portfolio that lies to the right of the one and results from a steeper indifference curve, such as that for investor A, an investor who is less risk averse, that means the right hand side, should optimally choose portfolio with more invested in the risky asset portfolio and less invested in the risk free. So that means his investment should be more in the risky assets side.
So
Then
the
only he will
second
get
indifference curve.
higher returns. Yeah, then only he will get higher returns. Okay, you understood
Yes.
this one meaning?
Yes, sir.
Okay. These all are just something we have already done. Standard deviations, variance. Okay. It's did the same one only here.
Okay.
If you want, you may read all this. Just read all this. Yeah, read all this. I'll just connect the charger to the laptop. Just read all this.
Yes, sir. Done, sir.
Hmm. One second. See. Yeah, you read this. You understood this.
Yes.
Okay. These formulas are all fine. This is all just a repetition. All these you go through. Here, this is the uh, notation that they are using. Correlation. Actually, correlation R is the one, but something similar to P they are using. P. Correlation between 1 and 2. Covariance divided by standard deviation 1 into standard deviation 2. You may just go through this as well. All this. All these are important also, okay? You will certainly get questions from all this because they prefer asking all this theoretical style only.
Okay. Done, sir.
Okay. Calculating mean return variance, return covariance, and correlation. So mean return is you just have to add divide by 3 here. Then anyways, now you can use shortcut as well. Just try once shortcut second
Okay.
7 and then key in these details. You can ignore percentage and key in the data. So
Okay.
for x variable 5, y 7, and x minus 2, minus 4, 12, 18.
Yes, sir. Done.
So now you must have found out mean, mean, see, and then standard deviation you can get it. So with standard deviation you can get variance.
Yeah.
Okay, so you just calculate variance.
First is 49 for the first
Yeah, is it
asset.
matching? Variance
Variance.
49. Yeah, correct. So that means standard deviation is also fine.
Yeah.
Its root will be 7. Yeah.
Second 121.
Hmm. Okay. And then, so now, how do we get covariance? They have asked covariance as well, no? So what will you do? So that is your formula for covariance. Covariance of x comma y is equal to summation of x minus x bar into y minus y bar divided by n minus 1. However, there is one more formula. Correlation is equal to covariance divided by
Stop.
variance of the market. Market is x, let's say. So now based on this, I can say covariance of x comma y is equal to r into variance of the. Acha, no, this is wrong, no formula.
This is
Standard
standard
deviation of x,
deviation.
standard
Yeah.
deviation of y. So standard deviation of x, standard deviation of y. Okay, now you know r. You can get it from that calci. Standard deviation of x, standard deviation of y also you know. So you can find out covariance also. Try.
Yes. R is 1.
Okay, r is 1.
Yeah.
Okay, fine. Okay. Okay.
77.
Yeah, 77. Okay, understood this one.
Yes, sir.
If you want to do manually also, you can do manually. You know how to do manually all
Yes.
this? Okay.
Yeah.
So at home later on, you may practice it also.
Okay.
Okay. Then variance of your portfolio. Now, just sometime back we were doing, right, standard deviation of your portfolio.
Yeah.
You take the root out, it will become variance. This formula is okay.
Yes.
Okay. Then, yeah, all these we have done. Standard deviation of the portfolio. This is R, okay? R.
Okay.
This is all we have done. This is a pure just plugging in the number. Just try this. Standard deviation of your portfolio.
Okay. $12.89.
12.9. Okay. Efficient frontier. This is what I was telling you some time back. That
Yes.
correlation is 1. This is what I did, right? weight 1 standard deviation 1, weight 2 standard deviation 2. Fine, okay. When
Okay.
correlation is 1. You don't have to remember anything. You can quickly, you on your own can calculate and see all this. Then this is just, they have mentioned that a plus b the whole square formula. Okay. So these all we have already covered. Uh, Now this one, just go through this question. See, all they are trying to do is, it's a normal variance only they are finding out, but with different correlation. If correlation is 1, what is the variance? If correlation is 0.5, what is the variance? If correlation is 0, what is the variance? If correlation is 0.5, minus 0.5, then what is the correlation? Correlation is minus 0.5, then what is the variance? Okay.
Okay.
Basically, the point is, if correlation, see here, this is plus 1 is the highest, then little low,
Yes.
little less, this is negative. So when the correlation is the highest, the standard deviation will be the maximum, or the variance will be the maximum comparatively. See here, this is 21.5 percentage, 18.7, 15.4, 11.17. Can you understand why? Because just imagine this correlation. This is R. If R is lower number, see, if R is 1, then this is 1. Okay, if R is 1, then all these numbers are positive numbers. Like let's say if R is a smaller number, then all these will become smaller.
Yeah.
If R is 0, then all these will go away, this number will go away.
Yes.
Okay, so that's what they are trying to show over here. Moral of the story is what? If the correlation is less, then the risk comes down. How you should articulate this: if the correlation is even negative, then the risk is very less.
Okay.
Understood this one?
Yes.
This you can ignore. It is just the same thing, only they have put it graphically. Okay, you can ignore this one. Then minimum variance portfolio, minimum variance frontier. So this one I should show this practically to you. This one I'll show this practically, but I'll give you some rough idea as well now. This minimum variance portfolio, this graph or this concept is also called as modern portfolio theory. Modern portfolio theory. Modern portfolio theory. Modern portfolio theory, this was given by Markowitz, Harry Markowitz. Harry Markowitz, he gave this concept. Now under this, what happens is, what he did was, he got Nobel Prize for this. Long back he did. See what he did, everything so manually he did, without computers and all. So what he figured out was, for the given level of risk, this is the risk and this is the expected return. So there can be one portfolio giving this much return, another portfolio giving this for this risk. Like this, plenty of portfolios are there.
Right.
Okay. So he then drew a line like this. Then this tells you these are what the best stocks for the given risk. Correct? Why? Because if this risk you are ready to take, will you go for this portfolio or this portfolio, the upper one? Correct?
Yeah.
Okay. So these are called as efficient frontier. These are called as efficient frontier. Okay. Efficient frontier. And this one, the one with the least risk, is called as global minimum variance portfolio. GMVP. Global minimum variance portfolio means portfolio with the least risk.
Okay.
Portfolio with the least risk. Then portfolio with the least risk. Then rest all these are inefficient portfolio. Inefficient portfolio. All these are inefficient portfolio. Okay. Minimum variance frontier. Overall, all these are called minimum variance frontier. Together, all these are called minimum variance frontier. Minimum variance portfolio or minimum variance frontier. All this. Minimum variance portfolio or minimum variance frontier. Okay. So how to get this one? Shall I show? It will take like maybe like 20-30 minutes it will take. Is it okay?
We can
In
do it
Excel?
tomorrow, sir.
Okay, then. Okay. So this one you just remind me that I have to show this efficient frontier practically. Okay. So in Excel sheet will do. Okay, I think yeah we can stop here. Anyways, it's getting over only. Okay. So this we can begin with this practicality. Tomorrow for the time being we'll keep it evening only.
Okay.
Tomorrow or I will put a message in the group. I'll try to keep something maybe like 11 if possible. I'm not sure for tomorrow. Okay. For tomorrow, I'm not sure. I'll just see how I can plan out. But I'll